How's it going, everyone? My name is Derek Afasi, and today's topic I want to discuss with you what is a thrift savings plan and how can you leverage a thrift savings plan for your retirement planning and your eventual retirement income planning. Now, a thrift savings plan is very similar to kind of how a 401k account works or any sort of qualified retirement account. What do I mean by that? Well, a thrift savings plan is meant specifically for federal employees. Okay, so what happens is an individual would work for the government, and instead of being offered like a 401k plan, which is only offered through private institutions, or a 403b plan, which is offered through public institutions, a thrift savings plan is offered through federal institutions. So this individual will be working for this federal employer, and in return, the employer says, okay, listen, we're going to pay you X amount in salary, and we're also going to give you the option to place some of that salary into something known as a thrift savings plan. And you have to kind of think of a thrift savings plan like a bucket, like a bucket that you're placing money into that's going to be designated for eventual retirement income. So this individual is trying to accumulate money into this thrift savings plan by placing dollars and basically placing that into that bucket. And then also there might be something offered known as a match through the employer saying, okay, if you make $100,000 a year, we might give you a match of up to 2%. So this means if you take out $2,000, because obviously 2,000 of 100,000 is 2%, you're placing $2,000 into that TSP plan. Well, then the employer, the federal government, will also place $2,000 into that plan, so that year you have $4,000 that's working in your bucket to try to grow and accentuate that growth year by year by year. Now, if the match is 2%, but you decide to put in $4,000 and you're making 100 grand, well, that would be 4%, right? Well, if they're only matching you 2%, they're not going to go above what that match is. So that's very important to at least understand that concept. So if you put in $4,000, well, the company says, well, we're only going to match you 2% of whatever your salary is. So therefore, we're going to place $2,000 into that bucket. So now you're going to have $6,000 working for you. Another concept, let's say if you want to put in $1,000 and you're making 100 grand and they're saying your 2% match. Well, it's not as if they're throwing $2,000 into that account. It's up to a 2% match. So if you're putting in $1,000, then they're only going to place in $1,000. So you're only going to have $2,000 working for your bucket. So I want you to really understand that matching concept, because a lot of people don't really understand that. And I have a lot of clients that are in finance. I have accountants. I have doctors that something as simple as an employer match, when they say, oh, we get a 100% match. Well, it's 100% up to what? You have to understand that there's going to be specific criteria. It's not saying if you put in $50,000 into a thrift savings plan that the federal government is going to match you $50,000, because that's impossible. You have certain cap limits on either what they're going to match you and how much you could actually contribute into a thrift savings plan. Now, a lot of individuals watching this understand that you have many different angles on how you could set this up. You could either kind of stay the course and keep your money directly into a thrift savings plan, or if you understand that you're a little bit younger and you're looking to make contributions into a plan, well, the downside to the thrift savings plans are you have limited funding options, okay? So that means that maybe, with a typical 401k plan or typical retirement account like an IRA contract or retirement insurance contract, you might have, let's say, access to about 100 different funding options. Well, with the thrift savings plan, maybe you only have 9 different funding options. So obviously you have less eggs in your basket to choose, a really good mutual fund account. The way that your thrift savings plan is going to grow is going to be the amount of money that you're placing into it, the amount of money that's being matched into that plan, kind of think of that bucket, and then whatever the mutual funds that you choose that are being offered in your thrift savings plan, however well they perform. If the market crashes, then your thrift savings plan, didn't matter how many years you've accumulated this money, your thrift savings plan is going to crash as well. Just like how individuals seen that scenario in 2008. You have some individuals out there that had $1 million in their thrift savings plan, and after 2008 was done, they're now sitting at $400,000. That's a very realistic scenario, because there's essentially a big gamble when you're placing your money in mutual funds. So depending upon which stage you are in your thrift savings plan career, if you're kind of more in the later stage of, your age 50, your age 59 and a half, you have specific guidelines, you have specific advantages that are better than some of the younger individuals that are kind of more handcuffed to that thrift savings plan option and they don't have as much flexibility. What do we mean by that? Well, if you're 59 years old and you have your money in a thrift savings plan and this money has been accumulating, well, you don't have to go and leave it into the thrift savings plan. If you hit age 59 and a half, you're going to now be eligible to roll over a portion of that into an IRA type contract. And you make sure that this IRA contract has specific features that correlate directly to your goals, your retirement goals, whether that's for max growth or whether that's for max income or a combination of both. So if you are above the age of 59 and a half, it's very important that you do understand what those options are to make sure that you're not playing this big guessing game in retirement. You're not nervous that with the market crashes that you're going to see your retirement accounts completely plummet. There's ways on how you can preserve that, and that's by doing an IRA rollover. Now you have other majority of individuals that are watching this video that might be in their 20s, their 30s, their 40s, and they have this thrift savings plan option. Well, there's other types of criteria out there, something known as retirement insurance contracts, that allow you to place money, premium dollars into. It's more on a private plan, a private structure directly with insurance companies that allow your money to grow whenever the market goes up and not lose anything, have a 0% floor whenever the market goes down. So you have that safe accumulation within those plans. One of the disadvantages to a thrift savings plan is all the money that you've accumulated in that plan is going to be fully taxable. With some of these other criteria, these different options that you have available to you on the private side, all that money that's accumulated, then when you're looking to take it out, could come to you in a tax-free manner. So there's different ways on how to skin that cat, but just understand that with your thrift savings plan, you want to try to gain with the power of compound interest the best way possible and try to avoid something known as reverse dollar cost averaging. What reverse dollar cost averaging is it's a computation of negative aspects that could completely liquidate your thrift savings plan. What I mean by that is if you just take an average example of an individual that accumulated money, let's say they're age 62, they still have money in their TSP account. Well, if they leave it in there, they're still paying mutual fund related fees within this thrift savings plan account. They're still paying TSP related fees within that thrift savings plan account, miscellaneous administration fees, etc. They might be using a traditional advisor where that advisor is going to try to make recommendations to them on what mutual funds to choose, and that might be another fee known as a wrap fee. So if you have mutual fund related fees of right around 1%, you might have advisor and other miscellaneous fees about 1%, you're already in negative 2% before your accounts do anything. If you experience some sort of downward market loss, and you can because there's no floor on this money on that thrift savings plan account. There's no accounts that give you a specific floor unless you go into the G fund that's going to give you a measly rate of return. So if you go and you play the market, and let's say the market decides to crash like it did a couple of weeks ago, well then your account, everything that you were saving up can also plummet with that downward market loss. So let's say even if you just lost 10% in a given year, it's not as if you lost 10%, but then you also have to pay that advisor fee if you're using an advisor, and that mutual fund related fee of another 1% in that example. So you'd really be losing 12%. If you're looking to pull out income from this account, well then that's another negative. Let's say you want to pull out 5% income. That would be 5% plus the 10% plus the 1% plus the 1%. So you just have these negative aspects that you're constantly trying to chug in an uphill battle struggle, and it's not allowing you to get from point A to point B successfully, meaning your retirement successfully, because of those different negatives that are hindering that performance. So in doing so and watching this video, if there's anything that piques your interest, please make sure to give our 1-800 number a call. If you're kind of more in your earlier stage and you say, listen, I want to know some better private plans, might be specific to my situation, our 1-800 number is 1-800-566-1002. We are A+ rated on the Better Business Bureau. We've never had any complaints. We've always had very good reviews, and it's because of our methodical process. On top of it, if you're also, most importantly, looking for some sort of retirement income plan, that's how you could leverage it. And you're, closer to your age 55, you retired from TSP or you retired from the federal government, you have specific options for you. If you're still working for the federal government, you have certain options available to you if you're above the age of 59 and a half, that you could roll over those monies into something that would be direct and then correlate specifically to your goals. So when calling our 1-800 number, 1-800-566-1002, you'd call in. We offer 24/7 customer service because we handle a large volume on a national basis. And you say, listen, I want to talk to a thrift savings plan specialist. I want to see exactly what are my options to roll over this money and make sure that I'm really accentuating, my goals the proper way. And then what that specialist is going to do is ask you a slew of questions and get your brain thinking, saying, are there really any gaps with your current plan, or is it okay to just leave all your money in your thrift savings plan? There are some times where that is going to be your best option, but there are many other times that it might make sense to leverage a portion of it, throw it into IRA contracts, throw it into more private plans, set up specifically with financial contracts and proprietary strategies that the federal employees have access to. So, there's so many different ways to skin that cat. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel and, give our 1-800 number a call if you have any further questions. Thanks so much, guys.